Wayne Winegarden, welcome. Thank you for joining us.
Oh, thank you so much for having me.
Thank you. You played an early role in helping to define the clean tax cut concept. Can you please describe how low tax rates stimulate the economy?
Of course, it's a novel approach. All kudos go to Rod for coming up with it, and it goes back to really the tenets of economics and incentives, and the idea being that when you have a tax is a disincentive, and when you have higher taxes, that's going to disincent activity. Now, when you're talking about the problem of global climate change or any other type of pollution, you have this issue of an externality. And the traditional way of dealing with the externality is you put a price on it. But in this way, as opposed to focusing on the externality, what you want to focus on is innovations. And so you want to say, how do we incentivize the innovation that would, in effect, then address the externality, or in this case, lower overall greenhouse gas emissions? And you do that by changing the relative rates of return. So you want to lower the rates of lower the taxation on projects like clean energy, or if you're looking at extraction of rare earth elements, if you have a way of doing that cleaner, we have fewer emissions when you're extracting rare earth elements. That would be a project that lowers emissions, so you would give it a tax break. You would have a lower tax rate applied to it. And by doing that, you're increasing the relative rate of return or the relative profitability of the project that reduces emissions compared to projects that don't reduce emissions, thereby attracting more capital, more people trying to come up with that technology, and through that incentive, hopefully coming up with the innovations faster.
That's great. You and Rod co-authored the first article proposing tax-exempt co-victory bonds and loans, a private tax-exempt bond or loan. How would this work and how can it be helpful?
We were talking about this in reference to the COVID pandemic, and we're talking about, how do we stimulate the economy, and the ideas coming out of the national capitals was spend a lot of money. And of course, the project is, especially given the large size of government, that you have uh, the projects they invest on are too low return. They're almost like growth detracting projects. You're wasting money. You're spending money on projects that don't enhance returns, don't give people skills. So it's a kind of a double whammy where you're taxing that money away, or you're borrowing that money away from the private sector, and then you're spending it ineffectively by the government. And so the idea here was, well, as opposed to having the government direct where those resources go, what if we, for much smaller kind of reduction in tax revenues, have lower rates on bonds so that you're incentivizing private investment through getting more private investment. Now the private sector, which has a much better track record of investing in pro growth kind of projects that create value, you're incentivizing that type of activity and thereby creating the stimulus you need, one, for the government, much lower costs in terms of lost tax revenues, but more importantly, for the economy, you're actually getting kind of the innovative growth enhancing investments that actually increase productivity, increase lifestyle quality of life, and all of these things that we want in order to generate prosperity. That was the idea of the COVID bonds, and it's really based on just the idea that we want the lowest possible tax rate on the broadest tax base. That's the goal that we want to get policy toward.
That's terrific. It sounds like that would lower the cost of capital and be a more nimble way to stimulate the economy rather than some conventional subsidies. What about
Certainly.
carbon pricing? At climate conferences and the media, a lot of people talking about needing a price on carbon. How do clean tax cuts differ from conventional carbon pricing arguments?
Well, one of the problems with conventional pricing, carbon pricing arguments is that when you actually run the models, the actual economically efficient price on carbon isn't kind of at the levels where you would meaningfully change the amount of emissions. And the reason is because we still have binding technological constraints. We really don't have the ability technologically to lower emissions to the amount that we do without severe economic damage. And in that type of circumstance, going back to what we had talked about earlier, what we really now need to do is incentivize innovation. And so how do we incentivize innovation? We provide those kind of higher after-tax returns by lower tax rates. And so it's taking the problem differently, as opposed to saying we need to have the price of the externality built into the transaction. The whole idea of carbon pricing. When I go out and buy a product, I consider the cost of carbon in my decision. Well, as opposed to doing that, we want to say is, hey, how do we get the technology we need that would be lower emission technology, but economically? And so when a clean tax cut, especially when you do it on profit, it only comes into play once you have a technology that works. That's kind of the goal. So we're, again, bringing more capital to bear on this issue of how do we get a better technology.
So it sounds like we would get a reward for cleaner behavior rather than penalizing high emission behavior, dirty
Exactly.
power. Right.
It's the theory of incentives and disincentives. We want to incentivize. When you want to incentivize activity, you use a positive incentive. In this case, that positive incentive is higher potential returns.
Excellent. Now, let's turn to power markets. You recently did a study comparing monopoly versus competitive power markets in the United States, but what did you find and how might it apply to a country like Argentina?
Well, I think the most important thing we found is that when you looked at kind of the price growth of the competitive markets compared to the monopoly markets, that the growth in electricity costs was lower there. And that makes sense because the monopoly model is run off of a cost plus model. And so there's really no incentive to kind of come up with a more efficient technology because whatever cost exists, you're just passing that through with your margin. And in some ways, higher costs, same margin, more dollar revenue. So the incentives of the monopoly model are all wrong. And you see that borne out in the data where the price growth in those markets are much lower. That same concept also applies, by the way, to lower emission technologies, where if people are demanding, and in many areas they are, lower emission technologies, the competitive markets actually have an incentive to provide that, whereas in a monopoly setting, those incentives just aren't as strong. So creating a competitive market allows all consumer preferences to be considered, not just lower prices, not just kind of efficiency, having the lights turn on when you need it, but also kind of lower emissions and balance across all those attributes that matter to consumers.
Well, that seems like that would be a powerful factor driving companies to change their operations. Did you notice how much faster did the cleaner technologies decarbonize?
Yeah, in the U.S., you did see, in fact, the states, the competitive states saw. I should back up. Overall emissions in the U.S. have been going down. They've been going down since 2005, and they've been doing that for a number of reasons. But most importantly, natural gas has been a primary driver. And in that kind of transition to where we are now, the competitive states have seen their emissions decline significantly more than the monopoly states. And again, it's that flexibility, that pressure to compete, the pressure to serve consumers. It works. It works in energy markets just like in markets for soda, beef, or whatever product you want to talk about.
Well, that's great. Thank you so much. I know you've written a few studies. We'll be sure to share that with the group and post that up on our website. Thanks so much for joining us.
I appreciate the opportunity and wish you a great conference. Thank you.
Thank you.